Morning, everyone. Welcome to this morning's edition of the MPC Markets Morning Call, 21st of November, 2025. Despite all the optimism yesterday and the Nvidia earnings, tech stocks were absolutely smashed overnight. And there's a couple of different reasons that have been touted out there on social media and on the news wires, etc. They essentially are. They're around deleveraging, which we'll cover a little bit later. There's some questions being raised about the legitimacy of some of the earnings there for Nvidia's revenue because customers aren't paying, etc. And then this was I think personally the final nail in the coffin in terms of price action, and I've been talking about price action quite a lot, and I've been obviously highlighting this these technicals swinging down, and that was the fact that the fundamentals didn't really matter when there was upside momentum, but now that the momentum has gone. Obviously there are no fundamentals to back it up, and Nvidia was really the last bastion of that of those fundamentals backing it up, and they did report better than expected earnings. They smashed it out of the park, but the irony of the fact that there's been an AI that's actually found holes in the Nvidia earnings, which we'll cover just a little bit later, is quite ironic, I've got to say. But yeah, as you can see here, the SPY made a rebound yesterday. All of that Nvidia news was in the market at that point. So we had futures at one stage in the Nasdaq and up about 1.5%. So for it to be down 2.38%, we're talking a 4% drop in the market last night from basically the open. And that's enormous. That's really a significant move. That it doesn't. I'm just trying to emphasise. Down 2.38, you can probably pass that up, but like a down 4% move is enormous. So it really sort of started from the absolute get-go from the open. So I'm genuinely surprised that the SPY is only down about 0.5% at this point at 8,800. But I mean, it is very tech-based. But obviously the ASX being up 1.24. I mean, on the weekly, it's probably fairly in line, down 2.2, and because we've got the Nasdaq down nearly 4% for the week, the S&P down 3% for the week, and the Dow down 3.5% for the week. So yeah, I would imagine we've now broken the 50-day moving average. We're testing the 100-day moving average. We're very close there in the S&P. And the 100-day moving, being above the 100 and the 200-day moving averages is literally the only two technical indicators out of I think it was the 12 technical indicators that we combined for this. Being above the 100 and the 200 are the only two left. So look, I'm just going to cover. It was really interesting this morning. And look, this was AI generated. The guy who's posted this has been is really bearish. So just take it with a grain of salt. One of the other reasons was the deleveraging, and there's people blaming Bitcoin getting hit on the back of this. I don't subscribe to that. Although the deleveraging is definitely a thing, whether it's Bitcoin's fault or not. We were just discussing it here in the office this morning, and it's probably more than likely the other way around, to be honest. Because I can't imagine you're getting, you're not getting as much LVR on Bitcoin as you would be on Nvidia, because it's the market darling. But so the receivables was the big thing in this. So there's significant delays in customer payments. So what they're actually saying is that they're announcing revenue that actually hasn't been paid. To the point of it was quite significant. It was they generated $14.5 billion in actual cash, but reported $19.3 billion in profit. It's a $4.8 billion gap. So we've had a lot of people talk about these circular deals with Oracle to OpenAI and But essentially, and the fraud is a very strong word. Don't agree with it. I've just summarised what these people have said. But it's underpinned by Nvidia provides capital to the AI startups like XAI or OpenAI, etc. And they use that capital to then lease the GPUs from Nvidia, allowing Nvidia to book revenue without any real net economic result. So we have known this for quite some time, but bringing it to the surface here, and this is what the I would say the likes of SoftBank, the likes of Peter Thiel, the likes of Michael Burry are all talking about is that you can be generous with your accounting sometimes, but now we're getting to the point where not only is that that those circular financing deals was probably the last straw that made these guys go and really dig under the surface, and actually look at these numbers. And as I've said in the previous podcast, Michael Burry we haven't generally listened to for quite some time, and he's been wrong about a lot of things. But what made him so good in the GFC and the star of The Big Short was he got down and dirty in the detail, and read the things that no one else reads, and I did mention that at that time that this is the sort of thing you actually do want to listen to Michael Burry about, because it's his strong point. It's his that's his jam basically. So yeah, the other things here, operating cash flow was significantly lower than net income, cash conversion ratio of 75%. So the rest of the chip makers, cash conversion's around about 90%. So, and then the inventory claims as well, and if you think about it, Jensen said yesterday, and he's very smart about it, Blackwell demand was off the charts. He was smart enough not to use a number, but the bottom line is that and this again, there is skewing on both sides of the balance sheets here. There's the positives and there's the negatives, and the positives on the positive people on Nvidia might say, well, that inventory increases just their manufacturing capacity's gone up, etc., etc., etc. But inventory increasing 32% quarter over quarter. Is and which is about 20 billion, really is counterintuitive to insane demand and supply shortages. So, it really is it's worth questioning. Is I guess is my point. And then the historical precedents are brought up. Look, this is way. This isn't an Enron. It's not a WorldCom. It's not a Lucent Technologies. This is where you've got to be careful, because I think the media likes fear and it creates a lot of clicks. But this is the sort of hype fear that's going to start coming in. That seems fairly ridiculous to me. These companies, but the point that we're trying to make is vendor financing was used towards the end of their cycles to inflate their numbers. So. Yeah, but be very careful because there's going to be a lot of fear out there today on this, because and there's multiple reasons around it. So as you can see, Nvidia down 3.15% for the day, Oracle down 6%, Palantir down 5%. So all the market darlings just getting hammered. Micron down 10%, AMD down 7.5%. I'm pretty impressed with Tesla only being down 2%, I've got to say. But look, and then Apple's got a lot of cash, so they obviously that was they're the least affected. Berkshire Hathaway was flat again, sitting on a lot of cash, so they're not very affected as well. Palo Alto was down 7%, Netflix down 4%, and then you just sort of Walmart had a good result, Procter and Gamble, but the only sort of speckles of green are these super defensive sectors, but there ain't too many speckles of green. You probably count about 30 out of that, and there's 500 stocks on that heat map there. So, but yeah, as we've been saying for quite some time, it was a great time to go to cash. It was coming into question. The last domino to fall really was the momentum. And now, look, I am genuinely concerned about this market, because we did have payrolls numbers overnight, and they were higher than expected. That took the rate cuts completely off the table. but the numbers were largely dismissed. The unemployment rate went up to 4.4 despite that, because the participation rate was higher. We didn't think we were going to get those numbers, but they managed to get those out. There were downward revisions to the previous ones, but where we're concerned is the layoffs that were announced in October, and we don't know when we're getting the October numbers from the Bureau of Labour and Statistics. They may be, they're the ones that we were worried about. And look, and it's managed to, there wasn't much really printed about this. Everyone, I mean, Nvidia was up 5 to 6% when it shut in the aftermarket session yesterday. So we're talking a 9% downside move from where it closed when we did the morning podcast yesterday morning. It was an outstanding result on the headlines. I can understand why people are picking under the surface, because these things have probably been happening for every Nvidia earnings for the last God knows how long. It's just that, the way that the market is and the way the news cycle is now, we pick under the surface only when it suits the move, really. The analysts are extraordinarily guilty of it. They tend to do that quite a lot, and they'll retrofit an investment thesis to the news, where the reality is, which they don't want to admit, is that the algos run the market, momentum runs the market both up and down, and fundamentals have never meant so little, and particularly going to be in an AI age, and they're protecting their jobs essentially. You've got to take into account the fact that computers run off maths and stats, and algos will run until they hit a big order or the momentum slows, and now we're probably going to get a bit of a dose of that downside momentum. I'd be very if we get another daily settlement lower, and look, I'm just going to go through the Nvidia earnings here and the chart. So this is a 10-minute chart. So Nvidia came out with their earnings, was about 185, and it just went. And you can see the blue section here is just, it spiked straight away. It dipped back down here. There's a bit of poor price action. You can see the high volume there. And then the earnings call got that other little jump there, and then we settled around about the 196 area. It went largely sideways in the pre-market session from about 8 o'clock at night last night Sydney time. But I mean, have a look at this. Is basically the big red candle here and the huge high volume on the open. Literally, it was just hit from the moment that first bell rang. And we went and had a look at the daily volumes as well. This is one of the top three volume days for the Nvidia stock since probably June, and one of the biggest for the year. And when you see pivot points like that on volume, they're usually the start of something. Around this 180 mark, and I should have probably put this line in, but 180 was a low. On 3 previous occasions on the intraday charts on the hourlies, and Finn and I were watching this into the close on a 1-minute chart, and it was protected really heavily into the close, and it closed around about 180 and a half. A break of that 180 point is Nvidia's in trouble, and a weekly settlement below that 180 point, it's not going to bode well for the market. And we're talking about the stock that's 7% or 10% of the Nasdaq or whatever, and 7% of the S&P. So it's going to weigh. Let's face it. So yeah. And for the record, I had Nvidia for stock of the day yesterday. I did say trim for other opportunities, but again, I would be. This is a high quality company, high quality earnings. And probably one of the first ones you'd be buying on the dip in the event that it comes off. But, I'm not looking at this till it's below 140, which is another 20% away. And it's not because it should get there. And I think every broker under the sun upgraded this stock. One of the brokers upgraded it to $350 price target last night, which is 100%, just shy of 100% from here. But yeah, it will be a buy at some stage, just not now, because the sentiment is souring a little bit. And that sort of brings me to this is where they're talking about deleveraging as another theory. So, I mean, this chart looks, you'd love it if it was a stock, but it's not. So we're talking about millions of dollars So yeah, what are we at here? 400 well, 440,000 million. So it's, yeah, this is the amount of debt or depository institutions, loans for purchasing or carrying securities. So this is, not necessarily margin lending, which has gone beyond trillion to 1.2 trillion. But I mean, this is probably more to show the amount of leverage that is out there in the market at the moment. And if we're going to deleverage, look at how much money needs to come out of the system here. We've been a little bit worried about this for quite some time, but like I said, you just can't fight the momentum. And if these guys keep getting lent money, and the market keeps going up, which means that they've got more LVR to lend more money, it snowballs and it becomes a self-fulfilling prophecy. However, that works in both directions. The dreaded margin call is the worst thing you can ever possibly get as a trader or as an investor. And those who are using it, you can go from hero to zero extraordinarily quickly. And I'm from a futures and derivatives background, which is inherently 10 to 1 leveraged. So very familiar with this sort of thing. And things get very, very irrational very, very quickly because you're being force liquidated, and quite often automatically force liquidated, which has caused flash crashes in the past, to be honest. And particularly the last one was related to Bitcoin. I think that's probably drawing a very convenient correlation. I think it's just leverage generally. There's leverage across all asset classes at the moment, and it's out of control. So I mean, not the greatest end to a week, to a Friday. It's a little bit grim, but I think personally that the biggest part of our job is to keep you out of trouble, more than anything else. Bull markets are great, but it's rising tide floats all boats. So I've been nibbling at it over the course of the last couple of months. We're back to 30 to 50% cash here at MPC. Do the same. I highly recommend, general advice only, but I mean the power of that cash to be able to buy the dip and set your shopping list. But the power, just think about how you felt back in April when the market got smoked. If you don't want to go through that again, prepare now. Don't be that guy with a garden hose trying to stop a bushfire coming towards you. We've got uranium's obviously, that was a super hot thematic. It was down 7% last night, down 7% for the week. Gold, silver, copper, platinum, it was a bit of a sell everything rally. That will tend to be the case in a deleveraging rally. Because there will be people who are leveraging off their gold as well because they've done very well. Bitcoin down 12 for the week, down 3.5 for the day. There's been a lot of people talk. I don't think people are necessarily caught out in Bitcoin. I think the passive flow in the in the ETFs is going to mean that we're not going to have those ridiculous halvings or like sell-offs of 70%. Anymore, because I think there's real money in there now, and it would be very high on my list of things to buy, on a dip as well, because the digital gold sort of thesis. But I would expect silver to probably take a little bit of a hit. It is a risk on, it's a risk considered a risk asset, as will copper. So be a little bit patient there, but. Cash is probably your best position at the moment, and the power of cash when it dips can really set you up for the next 2 or 3 years. So I would highly recommend, as I say, going back to those high levels of cash, getting rid of stuff that you're worried about, and just cutting the cord, and and then start formulating that shopping list. For our clients, just email them in. If you want a portfolio review, give us a call, or email us. You can find our email and our details pretty much everywhere. So Yeah, thanks for listening this morning. Have a chat. We'll go into this a little bit more depth. Have a bit of a chat about this on Bulls versus Bears with Jonathan Takadina. But have a great day, and we'll speak again next week. General advice warning. The content presented in this presentation is intended for informational purposes only and provides general advice only. It does not take into account your personal objectives, financial situation, or specific needs. This information should not be the sole resource when making investment decisions. We strongly recommend you seek the advice of a financial professional.